You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Hey, Jim. Thanks for having me.
Some people have told me they believe the worst is over for the equity markets, that they expect things to improve now, that the worst losses have taken place. Is your information confirming that?
No, and that is exactly what I would expect to hear, given where we're at. I mean, that's the kind of thing that actually you need to hear. You have to hear. You don't hear that sort of thing at a bottom. At a bottom, everybody is scared to death of the market. And on the way down, like I said several months ago when this first started back in the summer, I said that there would be false bottoms and false hopes along the way. And I think that that sentiment you're talking about is in regard to a false bottom and false hopes.
What is the reality?
The reality is that they have stretched this thing beyond belief, the longest extended 4-year cycle in stock market history. I think their back's against the wall. I think it's all uncovered. I will not change my opinion on that because the data is what the data is. This advance into the top last year occurred within the context of a secular bear market that was pushed to a new high strictly because of the liquidity infusion. It slowly but surely, 2015, we saw the setup materialize. In August, we saw the Dow theory, or actually it was in July and into August, that June, July, August timeframe, we saw the Dow theory primary trend change occur, and then we saw that low. We've had a failed rally into November. I mean, we like cogs in a wheel. We've seen the setup unfold, and now we're at another false bottom, and people think that the worst is over, and it's just not. The statistics have not been fulfilled. I think that the powers that be are fighting this thing. They will fight this thing by jawboning, by taking the world to negative interest rates, by whatever that means necessary. But I just don't see them saving at this time under the current setup and given the structural things that have occurred to this point.
Why do they keep talking about bringing in negative interest rates in North America when clearly they have not had the promised result in Japan or Europe?
I really don't know. I see it. I guess this is just my opinion. I have nothing to base it on, but I guess it's just desperation. I think that they know if you kind of backwards engineer some of these extreme reactions, the only thing I can come up with is they know what a powder keg we're dealing with, and they just want to try to put it off as long as possible, hoping that the secular trend will reverse and that the market can catch, a solid undercurrent, if you will, and the thing turn. That's been the plan all along, but it hasn't happened. And so the only thing I can think is that when I look at these extreme measures, is it should scare people, because that's fear. They are the ones that are afraid by talking about these things. I mean, if all was good, would these measures be necessary? So that's how people need to think. I mean, these are warning signs that you're seeing and hearing these things.
Well, it's something that's never been attempted before, bringing in negative interest rates. Why would they want to mess around with something that's never been tried before if times are not good to start with?
I have no idea. I think maybe they think they're smarter this time. Everybody always thinks that, they're smarter this time. They have more control, more. I don't know. I really don't know. I don't know what they're thinking. I don't know. I can't speak for that. I just think that it, from my seat, it is an act of desperation to try to keep the wrapper on it. And the reason they're trying to keep the wrapper on it is because I think, obviously, they know how dangerous the setup is, and what the downside potential is.
Here they are talking about negative interest rates, yet we're told one of the biggest dangers we have is the outstanding consumer debt out there at record highs. Why would you want to discourage people from saving money and stop using their credit cards?
Well, the first thing that comes to mind there is that, they don't care about me or you or any of the other consumers. They don't care. People think, well, the powers that be, they wouldn't do this, they care. No, they don't care. They don't care that you're going to, that you're being hoodwinked by the market and that you have your life savings in this thing, and as you're trying to draw you into the market, and that if and when it collapses, that you lose your life savings. They don't care. What's more meaningful, I think, to them is that they try to paint the illusion and blow the smoke up everybody's skirt that everything's okay to keep you in the market, so that they can keep some sort of a calm amongst the cattle, if you will, and avoid the stampede.
Now, where should people be stampeding?
I would be stampeding, like I said, I think it's a time for cash. There was a wise old investor told me one time, and this isn't sexy, it's not what people want to hear, but it's a fact that, he said there's three positions in the market. He said, you either want to be, he said there's a time to be aggressively, and really I guess there's more than that, but his point was simple. He said, I either want to be, I forget exactly how he said it, but he said aggressively long, aggressively short, or aggressively on the sidelines. And I think this is one of those times, people are conditioned to think that they have to always be in the market, and that's just not the case. I mean, when the risks are high, and of course I guess that's the problem is people not knowing and understanding how to assess the risk, and everybody's got an opinion, and some opinions are valid and some opinions aren't, and some, what I mean? So, risk is kind of an elusive thing. Like you said, people are saying here that everything is good, and this is, like I said, in my eyes, this is the most dangerous setup it has been for the last year since the inception of the averages in 1896. And I say that because of the setup, because of the extension of the advance, and because of the statistical probability associated with the setup and the unwinding of the longest advance in history.
After 6, maybe nearly 7 years of advances on the stock markets, for many people trading, younger people, they've never seen a big downturn before. They don't recognize it. They don't see the warning signs. They don't know what the warning signs are. Is that one of the I
think that's one of the problems. I think that's always one of the problems, and it's those things that create the cycle itself. It really is. I mean, you have, like I said, you have short-term, intermediate, long-term, even longer-term cycles, and all of these cycles are based on human emotion and behavior at the various degrees, and everything is discounted into that price bar, and the psychology. What people know about the market, what they perceive to know about the market, what they don't know about the market, the sentiment, everything about the market is discounted into the price bar, which is reflective in the cycles themselves. And you can quantify the cycles, and I'm telling you, I don't know with certainty anything. I mean, I assume today is Thursday because I've been told that, and the calendar says it. But it could be Saturday, and maybe they got the calendar wrong. And so that being said, I don't mean to sound like a smartass, but that being said, all I can do is go by the statistics, and unless this time is different, those statistics tell me that because of, like I said, all of the things, the environment in which this has happened, that the risk here is enormous. That, and I'll say it, I think I've said it before, the risk as this cycle unwinds is that we go below the 09 low. Now, does that happen? Do I know for a fact that's going to happen? And this isn't doublespeak, but it's a fact. I mean, I don't know anything for certainty. I know what the risks are based on the statistics, and I stand by those statistics and that risk until it proves to me that, okay, this time is different. Because since 1896, those statistics have been 100%. And so while there is some margin that maybe this time is different, like I said, I stand by the statistic until it proves that it's different. So that's not doublespeak. I just want to say that, well, I think that makes sense, that it is what it is until it proves that it's not. I guess that's what I'm trying to say.
We'll have more with Tim Cyclesman Wood right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Tim Cyclesman Wood. The central banks across the planet have this theory that they can manipulate things to go their way, but people who follow cycles like yourself say manipulation, manipulation, it doesn't matter what you call it, but it just doesn't work. All you do is you may delay the inevitable. I guess you throw a bungee cord to a guy going over a waterfall. Eventually that bungee cord is going to stretch just so far, and then it's going to snap and he's going to go over anyway.
That's not a bad analogy, and you're exactly right. And it's just like the advance coming out of the 2002 low. We've talked about this over and over again, but it is what it is. They pushed and stretched and pushed and stretched, and at that time that was it tied one of the previous 4-year cycle advances. But they pushed the market to a new high within the context of a secular bear market. And I said it's only making matters worse, and that we were still going to go below the previous 4-year cycle low, which at that time was the 2002 low. And we did. And that was based on statistics and cycles. And so all the manipulation and everything that it didn't change anything. It just extended the cycle. And so you're exactly right. I mean, it's like trying to hold back the night of day. You can flood the sky with spotlights, but it's still dark. And dark is still going to come, the next day and the next day and the next day. You can try to camouflage the reality, but it doesn't change the reality. And so I don't know if that's a good analogy or not, but they have just, they have stretched the cycle, but they haven't changed anything. Like we talked about, over the course of the last several years, we've talked about this, all of the stuff that they've done, it hasn't changed the volume characteristic of the market. We haven't seen a peak or upturn in velocity of money of any significance. We haven't seen the job participation rate. We haven't seen any real data that supports their efforts or that tells us that their efforts have substantially changed anything or pulled us out of this secular bear market, or that the economy is really recovering. We've seen nothing. It's all been smoke and mirrors with this extended cycle. And the fact that we're seeing no fear now it tells me that we're right on track. And we had an intermediate degree bottom. Once we get to set up with this intermediate degree top, then the downside should resume, and we should press lower into the 4-year cycle ahead.
Taking a look at those cycles then, Tim, what can we expect for the rest of the year, say on the equity markets?
Down. Like I said, the statistics, we have the setup. In 2014, this has been fascinating to watch from my seat, because we know, like I said, the normal duration of the cycle, but then we know that cycles contract and they extend, and that being said, then how do you know when you've gotten to a top? Okay, so if it's fluid, then how do you know? Well, that's where the DNA markers come in. So I developed the DNA markers going back in time and found all these common denominators at all these 4-year cycle tops. So in 2014, we started seeing some weird stuff, and it started trying. But it couldn't quite. It was like cogs in a wheel, and it'd try, but it couldn't quite catch, and nothing would ever materialize. And so it continued to stretch and stretch and stretch and stretch. And finally, as we get into 2015, we start to see one by one, and it slowly, all of 2015 was a setup. It was a setup. But one by one, it happened. Well, now it's there. And another thing we've talked about before, but it's just true, is that when something so abnormal stays so abnormal long enough, it's perceived as the new normal. And this market being extended like this and being up, that is perceived as a new normal. And here we sit with this setup, which nobody understands the work because they haven't done it. They haven't been exposed to, well, unless they've been exposed to it from reading the letters and stuff. They don't understand the setup, so they don't understand the risk. So there's this perception that everything is fine based on this perception of a new normal. And then you have, all the jawboning going on with the powers that be. And I understand them wanting to keep things together because if and when these statistics are fulfilled, it is going to be quite the show. And I understand wanting to delay that. But in the meantime, the sheep are just quietly asleep. They don't understand. And all the while, like I said, I feel like because of the extension and the things that did fall in place last year, that this is the most dangerous market environment ever. And that's where we sit.
What are the cycles telling you about the price of crude?
Crude oil, I had a target for crude oil to go into the 20s, which we did. Now we've bounced. So far, the structure is still broken. I think we may have one more push down into an annual cycle low. We're getting close to the time frame in which some seasonality, some seasonal lows come in, and so I can't say that we've seen that low yet because the structure has not turned positive enough for me to identify that. So I'm thinking that we may have another push down in crude oil before we get to that point. But I think we're getting close to at least a seasonal type bounce in crude oil. And then we have to see what the structure with that cycle brings. If it has the traits of just being a counter-trend bounce, then so be it. If it has the traits, and when I say traits, I'm talking about the structure in which the cycles unfold as we come out of that low. Are they right translated? Are they left translated? How many cycles, short-term cycles, do we see up? That sort of thing. I know it doesn't make sense to anybody, but that's what I have to see. And then if it's positive, then great, it's positive. If it's not, then great. Then it's going to be a counter-trend bounce and it's going to go lower.
We have a question from one of our regular listeners, Robert Ross. He asks, have you seen all the DNA markers that confirm that we're in a downward trend?
Yeah, that happened back in July, August time frame. We 2014 was a setup, like I said, 2015. We saw one by one everything fall in place. And so now it's just how fast do the wheels come off of the cart, and that's what we're monitoring. We have now that we have the markers for the higher degree top, the question is, and the things that I'm watching in the letter and reporting on is how do we progress from here? How fast does it come apart? Where are we in the shorter term cycles?
What's the cycle for the U.S. dollar right now?
The U.S. dollar is at a critical point. Actually, I am concerned about the U.S. dollar. It's scaring me. The dollar, if something doesn't change quickly, it's going to be at a point where coincidentally, it's not a 4-year cycle in the dollar just because there's a 4-year cycle in the stock markets. There just happens to be a 4-year cycle in the dollar as well, and they're not necessarily related. But if things don't change quickly with the structure of the dollar, then I think we're going to see the solidification of the 4-year cycle top in the dollar. So we're at an important juncture. The dollar has to make some decisions here structurally. If there's going to be another, any additional strength into that 4-year cycle top, or if we've possibly seen that top. So we're kind of in limbo there.
Tim, thanks a lot for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. Also, if you have any questions for Tim, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.